Uh, Welcome, students. In this edition of live virtual classes for May 2026 examination for the paper to Advanced Financial Management, ICAI Ashish Gupta, Joint Director, Board of Studies, welcomes you all. Now, student, continuing our chapter number one, that is financial policy and corporate finance. We are now here. We have looked into some aspects, and we have also discussed what are the theoretical aspects of the financial planning, etc. And then we have come to the start discussing the topic of external funding requirement. So in today's class, we shall continue discussion on our assignment, as well as I will start the chapter number two, that is the risk management in today's class as well. So student, I think this class will also, the chapter number two will also continue for the, maybe in the next class if it is required. So, okay student, now let us start solving the assignment that for the chapter number one, there are two questions have been left. Okay, first we shall solve them, then we will proceed further. Meanwhile, if you have any query, you can ask us through the query handle, or you can also post your query at the chat. Okay, thank you. Let us start, student. One second. अशोक जी वो पासकोड मांग रहा है. पासकोड मांग रहा है ये. आता है कैसे पासकोड कोई? ठीक है. Just okay, no problem. I just make it out. Just a second, student. I am just sharing the screen. My अशोक जी just आशीष आईपैड को परमिशन दे दीजिए. Okay, student. In the last class, we were solving this assignment, and we have proceeded. We have solved this much of questions. Now, in the previous class, we have seen the situation where we have been given three scenarios. Now, in today's class, we are taking another question. Here in this question, there is some peculiarities. Okay, there are some conditions are attached.
Recording in progress.
Current year, sales to short-term loan and payable and provision should be in the ratio of 4:3. So these are the conditions. This para is basically relating to the conditions that should be met. In the earlier example, there were scenarios, okay, where the dividend were declared and fixed. So there were the changes like regarding the payment of dividend and regarding the conditions regarding the change in the assets. Or here we have to meet some conditions regarding some financial structure, capital structure. And here the company further desires that during the current year, sales to short-term loan and payables and provision should be in the ratio 4:3. Ratio of fixed asset to long-term should be 1.5, and debt equity ratio should not be exceed 1.5. So these are the three conditions that we have to met when we are meeting some external funding requirements. So first of all, what we require, you are required to determine the external funding requirement. Okay. And next is the amount of the fund to be raised from the short term, long term, and equity fund. So student, please note that you just make it correction. It make it like that: short term loan and equity. Okay, so let us start solving the question. Now, in this question, when we say, first of all, we have to compute the external funding requirements. So it is plainly very simple procedure as we have done our in a previous class. So quickly we start solving the first part, external funding requirement. Okay, so here are the particulars and here the amount in lakhs. Okay, we will solve this question with the both methods. Then I will solve the formula based approach as well. So our sale is basically the last year sale was 6,000 lakh. Okay, in addition to that, it creates a 20% increase. So the figure comes 7,200. Okay, profit margin, very simple, given to us at the rate of 4%. And dividend payout ratio, 50%. Okay, so we can at the rate of dividend, what will be the dividend payout ratio? We will pay the half of it, that is 144. Okay, so the leftover will be retained earning. Balance to be plowed back. So it becomes 144 lakh, no problem. Now next question comes, how much additional fund required? I mark it as A. Okay, student, now this question comes, how much fund? Student, please see, here our balance sheet is, total is 1,400. Okay, so out of, sorry, 14,000. Out of this, there are two portions. One is this current assets, another is our current liabilities. Okay, so I can say that this will increase by 20%, true, and this increase will be 1,600. Okay, or this partly will be compensated by, as I told you, the current liabilities are the spontaneous source of funds. So a portion will be also financed by 20% increase. So it comes 400. True. So in that sense, if I say, okay, so student, I add up these two, that becomes 2,800 minus 400. it becomes 2400. Okay, accordingly, I can say 14,000 into 1.2 minus 2000 because it is the part of current liabilities that will be increased automatically unless and until something has been specified. Okay, so the balance will be my external funding requirement. Balance to be met from external sources. Okay, so here we can mark it like that. I have marked as asterisk. Asterisk means it is assumed current liabilities will be increased in same proportion. Okay, in the proportion increase in sales. Okay, student. Now we are coming to the second part, and second part it says the amount to be raised from these three sources, but provided we have to meet these conditions. These conditions are also required to be met. Okay, we should meet these conditions. Now, what are these conditions? That is, the current year sales to short-term loan and payable provision should be in the ratio of 4:3. So, first of all, we take up our first condition. What we do? We write here the conditions. Or we can write it simply. Sales to be to short-term loans and payable and provisions. Payables and provisions should be is in the 4:3 ratio. Okay. Accordingly, what we do? We compute the amount to be raised from short-term loans or funds. Okay, quickly we can calculate it. First of all, the new amount of short-term loan and payable and provisions. So student, as I told you, because we have to meet this condition, the sales to short-term loans and payable and provision should be met this criteria. Accordingly, our new sale is 7,200 lakh. Okay, so we have to meet this condition 3/4. If my sale is 4, then my loan and provision should be this much. Okay, it means to say like this. So accordingly, my new position of this short term should be 5,400 rupees lakh. Now, less existing amount of short-term loans and payables and provisions. Now, as I told you, this amount will be increased automatically. New amount will become 2,400, and I assume that I am not taking right now. My old loan is remaining the same because I have to determine the new amount because loan never changes. Please remember one thing very important: short-term loan will not never change automatically. It is only the current liabilities, and in the current liabilities, especially payables and provisions changes. Okay, don't commit mistake here. One second, I think. Okay, so the amount it is coming 5,400. It is coming 5,400. So amount to be raised from short term nil. Okay, student. Now in this case, if any student have a doubt, he or she is free to ask. So I'm now coming to second condition. Now my second condition says like that. If I say my second condition, the ratio of fixed assets to long-term loans should be 1.5. Okay, accordingly, I write the condition and start proceeding. I'm sure I missed. Okay, Ondam Chandra. See, beta, short-term loans are not presumed to increase in the same proportion because we approach to the bank. See, I tell you one thing, very common thing. As I told you in my last class, when we are increasing the sales, okay, our receivables, cash, inventory are presumed to be increased in the same proportion. Whereas in the same proportion, we assume that our current liabilities are also increased. Of course, in current liabilities, we include the short-term loans, but for short-term loan, we have to make some effort. Okay, unless and until it has been mentioned, so it is assumed that they will remain static. Okay, they will not increase proportionally because bank you have to approach to the bank every time. But while we are doing the trading or we are doing the business, generally the provisions and the current liabilities like creditors, bills, payables are increased proportionately automatically. Okay, now I think it is clear to you. Okay, beta. Now we are coming to the next short-term loans because we have to meet our short-term loan and this should be the 1.5. Bank OD, I very good question, Pitambar. Bank OD, you also presume in the same that they will not be increased proportionately because again they have to meet some criteria. Generally, for the creditors and the provisions, they are generally increased in the proportion, same proportion. Because business increases, your sale increases. For OD, you at least you have to appear again in the to the bank. So bank will not automatically adjust because sometimes it may be possible that maybe the some reasons that bank may not analyze the increase that your sale is increasing, because when you are trading, your sale is coming in, practically it is in the real life it is increasing, but from the figures bank cannot judge that your sale is increasing by 20%. Okay, now here the query, now here I just draw again the fix. Now let us compute the ratio of fixed asset. How will it, we shall compute the fixed long-term loans. Or I do one thing, I carry out this calculation on the next sheet page so that it come out neatly. Okay, now here rupees lakh. Okay, new fixed assets. As we presume, it will be increased in the same proportion. So 6,000 plus 20%. Okay, new fixed assets come 7,200 lakh. Okay, now long-term loans. As per the conditions, I have to meet these conditions. Okay, so my new amount of long-term loan should not exceed this 4,800 because I have to meet this condition. Okay, my existing loan amount, if I go my existing loan amount, long-term amount is 4,000. Accordingly, I deduct the same. Okay, amount to be raised from long-term loans, funds or loans, whatever we can say. So this is the maximum amount that we can raise. Okay, now we are coming to the third point, that is amount of the fund to be raised from the equity. Okay, and for equity, there is a condition is that ratio of fixed asset to long-term loan should be this, and debt equity ratio should not exceed 1.5. This is another condition. Okay, so I am coming to the third condition. Debt equity ratio should not exceed 1.5. Accordingly, now we compute the amount to be raised from equity. Yes, very good question, Pitamba. In the exam, you can write, you can draw the line freehand, but my advice to you, at least use the scale because it improves your legibility and readability. Okay, sometime it has been seen that, of course, you can draw the line, but preferably you carry the scale with you. Okay, it will improve your legibility of your answers presentation. Okay, so now let us start solving the same. Mm, amount to be raised from external sources for external funding requirement, whatever it was. It was 2256.00 lakh less amount to be raised from short-term funds. This is nil because we have seen this. There is no amount need to increase. Here, less amount to be raised from long-term funds. Okay, so it says that since our sale is increasing by 20%, okay, so we assume that the loan is also increasing by the 20%. Okay, so our loan is increased by 20%. One second. Yes, please check it out. 1,000. Yes. Okay, here we assume that it is to be increased by 4,000. Okay. Otherwise, sorry, my mistake. Please consider this amount. Not it is. I got forgotten. We have computed this amount here, 800. So we shall use the same amount here. I get little bit confused, sorry. So 800 we have computed here, that we have to compute it from the long-term loan, and same amount comes here. So balance will be raised from the equity. Okay. Now I am coming to this is I think I hope it is clear to you. Now I am coming to the one to another approach of solving this question. We can say it is a kind of an alternative approach. So I am writing here the formula. See here we have to see what are the conditions we have to meet. So first of all, we compute, as you know that it is slightly different because total assets minus provisions and the payables into sales, projected sales. It is bit quite different formula, but same is logic. Formula is the same, only terms are different. Okay, now my total assets is 1400, sale is 6000, 2000 is my provisions and payables, 6000 into 12,000 my revised increase in sales. Profit margin is 4%. Revised sale is 7,200 and 50% is paid out. So balance is retained. Okay, the resultant figure will be 2256 lakh. Okay, make calculation at your own. If it is a different, please do let me know. Okay, now we coming to the second part. This was our first part. Okay, so now first we amount to be raised from the short-term funds. Let X be the new amount of short-term loans. It is a revised amount. Okay, to meet the condition we can say like this: 4/3 increase in sales. 2000 is existing provision, it is increased 20%, and this is the see student, it is multiplication, it is X that I am using. Okay, any doubt here? Okay, when I compute the value, please compute the value of X. Just give me the answer on the chat box. Yes, Pitambar, you are right. It is 3000. Okay, student. Now, when we can write it like this: new short-term loan is 3 lakh, lakh. Okay, less existing loan amount, short-term loan amount. It also 3000 lakh. So amount to be raised additionally. That is nil. Okay. And this has been, if we go by our first solution, that is main here, the same was answer here. Okay, now we are coming to second part. Okay, let Y be the new long-term loan amount. To meet the additional condition, it comes out as follows. Okay, we have to meet 1.5 our fixed asset. Okay, this condition should be met. Okay, so since our fixed revised fixed assets, we can say it is a revise. So it will my revise will be 1.2 into 6,000 divided by y. Okay, my resultant figure comes. Please compute. Yes, Kadamba, you are right. It is coming 4,800 lakh. Okay, so new long-term loan amount is 4,800 lakh less existing amount okay, so additional amount of long-term loan to be raised. Okay, so I think it is clear to you now. And similarly, if we go back to our second answer, this was the same. Now we are coming to the last part, that is 23 part. Equity to be raised. Okay. Our external funding requirement is 2 to 5 6 lakh. Okay, less short-term loan raise, it is nil. Okay, long-term loans raise, so the equity to be raised now we have to check our debt equity ratio, whether it is meeting the condition or not. Okay, so our new debt equity ratio. See, now here we have to pay very good attention. 3,000 our existing capital, equity capital, 1,456. This is our the plowback portion. Okay, because it has been plowback. Okay, plus this is 2,000 our existing equity, existing reserves. Oh, sorry, my mistake. It is 1 second. Yes, sorry, my mistake. It is make it 4,014. 1 second. It is sorry. It is the additional equity. Okay, it is the additional equity, existing reserve, and 1,400 lawback. Okay. It is the additional equity, it is the plowback, and this is our existing reserve. These are our old items. These are our new items. Okay. Now just compute the value. What will be the resultant figure? What will be the proportion we can say? No, not zero. Beta. Yeah, it is. Yes, correct. Somewhere near to it. It will be somewhere near to 0.727 something. Okay. So it is meeting our conditions. That is the ratio should be 0.70. So, students, this was an alternative approach for solving the question. So, both approach can be adopted. Okay, unless and until anything has been specifically mentioned in the question. So, okay, student. So, we are with this we are have gone through the three questions of our first assignment. Now, I am coming to the last questions of the chapter one assignment, and this question is based on a we can say it is kind of some strategic decisions that we normally take. Okay, let us read the question. 1 second. Okay. Okay, so the questions is like this. DEF Limited has outstanding 10% bonds of rupees 220 crore that has 10 years to maturity. The call premium is 7% of par value of bonds. Since for the last some year, due to falling interest rate in the market, the company can issue 10-year bonds with the same feature of the same amount at the interest rate of 8% per annum. The flotation cost of new issue is expected to be 60 lakh. Okay, you are required to advise the company. So it is a kind of a strategic advice. The company whether it should refund the old bonds and issue fresh bond at lower rate or not. Present value factor at the 8% has been given to us. Now, student, I just briefly discuss the scenario. See, the company is basically has an outstanding debenture of 10%. Callable. 20 crore. Now, I want to know what do you know? Have any idea what is about callable bonds? What does it mean? Any student can just tell me what is callable bond. It can be redeemed. Yes, Sambar, you are right. It can be redeemed earlier. Now, this callable bond, see, when we will discuss the topic of option, that is derivatives, then it will be more clear to you. Basically, there are bonds. You know that bonds is a kind of a fixed income securities. It is a kind of a fixed income securities, and their complete analysis is covered in topic of our security valuation. Okay, when we talk about the bond can be over two category. Another, it is called callable bonds. Another is putable bond. Okay, callable bonds means right with the company to redeem it earlier, it before maturity period. And putable bonds is right with the investor to put to redeem to get redemption to put to get redeemed to put to get it redeemed before maturity. Okay, so putable bonds means the right rest with the investor that they can put submit the bond before the maturity. So this is a two type of bonds. Okay, so here it is a callable bond and the option rest with the company. So they have now they have become desirous that they want to redeem the bond that have been issued at 10%. Okay, and a call premium is since they are calling the bond, they are calling or they are making the payment earlier than its maturity period, they have to compensate the investor. Okay, they have to compensate the investor. Okay, so par value of bonds means whatever their face value. The since the bond for the last some years, the falling interest rate in the market, company can issue 10 years same bond. Now see here, 10 years maturity period have been left and 10-year bonds can be issued. So we can say that the company's finance will not be that much impacted because for the same time we can say there can have kind of a parity. Okay, today's zero period and the period of maturity is left 10 years. Okay, even new bond is today issued the same, it has the same period of. Okay, see student, I tell you one thing very practically. I remember that somewhere around in 2000 2001, I have purchased a bond of, I think, IDBI Bank. Yes, I remember that. because for they have come out with the issue, and I remember that the bond was carrying the interest rate of somewhere around 8 to 9 or 10%. It was on a higher side, very higher side. In comparison to today's rate, the amount was very big. Okay, so what happened? I have purchased a bond, but later on, when the rate of interest start falling, so I think the majority is likely to be due somewhere around in 2025. I remember that. So company what has done, they have since it was a callable bond, so somewhere they got them matured in the month of in the year of 2010 or 12. They have refunded my all the money because interest rate was very falling. So they must have even thought like that. Even yes, in the last class I told you, with Vedanta is coming out with the new bond issues to redeem their old previous bond that has been issued at higher rate. So this kind of a decision can be taken. Okay, so now the new bonds can be issued at the rate of 8%. So straightforward, there is a saving of 2% interest. Now, student, this is a type of a capital budgeting decision. It is a kind of a capital budgeting decision, and all the calculations will be oriented towards like capital budgeting decisions. So it is very simple. In a capital budgeting decision, what we need? One thing is initial outlay broadly. Otherwise, the correct definition is the called present value of cash inflow minus present value of cash outflow. But if we broadly analyze any decision, so it because this involves initial outlay and the present value of cash saving or inflow for a fixed period, or we can say for the entire period. Okay, for the project life, generally it is said that, so here the life of the saving we will get for the 10 years. We will get the saving for the 10 years. The saving will be for the 10 years. And what will be our initial outlay? Let us see by calculating the same. Okay, so let us first start with the initial outlay. Okay, first of all, it will involve call premium. Okay, the call premium will be rupees 20 crore into 7%. So just compute the value, it is 20 crore. I think I need to draw this line. Okay, 140 lakh. Similarly, first part is this, another is floating cost. Because this new issue will not be without free of cost, we have to incur somewhere around 60 lakh. So overall, 200 lakh, or we can say 202 crore of amount will be involved. Okay, next is annual saving. Or we can say our annual saving is a form of, okay. So old interest payment, we have to pay on 20 crore, we have to pay 10%. So the amount will be 2 crores. Okay. New interest payment. Okay. So saving of interest, it is 40 lakh per annum. So this is our annual saving. This is our initial outlay. Now we compute MPV of the bond refunding decision. Okay, bond refunding decision. Present value of saving amount of interest. Okay, so here the amount is 40 lakh per annum. We have to multiply PV factor. Student, please remember one thing, very important tip for your examination. Now, when this values has been given to you in the question itself, so please use the same values. Here you will see it is the three decimal point. Generally, the confusion come into the mind of the student, sir, up to how much decimal points we have to use in the examination. Now, students, so far as the if any factors or any value has been given in the examination question paper, so you follow the same. Okay. So now here the since the decimal point values up to three decimal point have been given to us, so we shall use the same. Otherwise, we can use four as well, three or four. If nothing has been mentioned, then the good practice is to value three up to three decimal point or four decimal point. Generally, two decimal point present value factor gives some misleading figure, because in case of a present value, the point and figures are in crores. So then even a decimal point matters a lot. Okay, so please remember this. So what we do, we add up all these values. Okay, and the value comes. What is the value? Just student, please add up this value and let me know. Very good. 6 point. Okay, so this will be the present value of the saving. Okay. So total saving is this. So what will be your decision? Since NPV of bond refunding is positive, we should refund the old bonds and issue new bonds. Now, please remember, student, this is one of the very important aspect. Whenever in the question, advise word or suggest, okay, or evaluate something like what have been used. So you have to give decision, especially in case of decide, evaluate, decide, suggest, or advise. In this, without this, your answer is incomplete. And even when we have reviewed the comments on the performance of candidates by the examiner, it is a common student normally forget to advise. In the hurriness, they even forget in the examination. So it is very important that they should not forget this. Okay, student. So I think with this we come to the end of the chapter number one. Okay. So and I not remember in the earlier class there was some student asking one query regarding cash position something I forgot. What Pitambar? What was your query, beta? At that time I could not reply, but now I just let me know. Okay, okay, yeah, 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 yeah. I recall it now. Pitambar, what I will do in the when I will end up the session before that, for the 5 to 10 minutes, I will discuss with you. Okay, I recall it now. I recall it now. Okay, don't worry. So, okay, student, we are coming to the next chapter. So, this chapter named strategic, sorry, risk management. Students, while we were discussing the topic of basically the advanced role of CFO in our earlier class. So there was a another one very important consideration and one of the very important aspect that is was the risk management. Now, when we talk about the risk management, it is also its importance increasing day by day. So now let us see what are the various points or various aspects that a CFO has to look into because nowadays no CFO can ignore this topic and especially post COVID, its importance has increased manifold. Now, student, there is one term like black swan event. Okay, what is this black swan event? If anyone knows about this event, just just say yes or no. What is in the chat box? Yes, anything unknown or unexpected coming. Okay, student. Now, when I talk about this black swan event, these events are why it is called black swan because generally swan are white and black swan are rarely visible. Okay, so that's why sometimes these events like pandemic, COVID-19 was a black swan. No one has expected. This type of events rarely occur, but once they are occurred, take place, it impacts a lot the everything. Okay, so this is called black swan event. Now, when we talk about, of course, black swan, it is quite difficult for us to predict the black swan events. But when we talk about other things, when other events, at least they can be some predicted and we can prepare for the same. Now, student, if I ask, there are some confusion between the term risk and uncertainty. Can anyone tell me what is their risk and uncertainty? What is the difference? Anything? Any single liner, whatever coming to your mind. Yes. Generally, yes, and yes, uncertainty not. Yes, you are right. Uncertainty means we cannot predict, or we can say we cannot attach any probability. Uncertainty means totally uncertain. We cannot visualize the same. Okay, on the other hand, for the risk, we can attach some probability. Okay, now when if you are going for a CA exam, then you know that of course my preparation is like this much. So risk means uncertainty may be directly led to loss. Let me check. Yes, you are right somewhere. Because different let me check into your chat. Risk means loss. Uncertainty may not be directly related to loss. Prithviraj, to some extent, your view is correct, but see, risk means we uncertainty means, of course, you are paralleling it with the gambling. Okay, in gambling there is uncertainty that we can gain or we can lose, but in the risk we can also gain. But only thing is that we have to prepare ourselves. Okay, when I tell you one thing, risk always does not mean the loss. It is a somewhere misconception, because when we will take the topic of portfolio management, and even I think in today's class I will touch upon it. It is something variation from our expectation. If I talk about risk, risk means variation from your expectation. So when we say variation from our expectation, so it means uh, yes, yeah, okay. So it means variation from our expectation means something we are expecting and it is deviating from the same. So this deviation is basically kind of a risk. It can be upper side or it can be lower side. Suppose you are taking the exam, C examination, and you are expecting your marks will come around 60. Okay, but if 65% marks comes, you become happy. Okay, of course, if the marks are lesser, if it comes to 55, then you get not you become unhappy. Of course, this situation is there, but risk is means we cannot predict accurately, but at least we some probability can be attached. So this is a kind of a risk management. Now, when and remember one thing, without risk, there is no business. Okay, the other name of the risk is a business. So we have to take the risk and we have to do the business. Okay. Similarly, when we have to going to exam, we have to take the risk. Of course, I will take the risk, or then I will go through the exam. Of course, what I have to do, I have to manage the risk, and accordingly, I have to prepare myself for the examination. Because now today morning you are attending our classes, BOS classes. Why? Because you want to mitigate your risk, or you manage the risk that I could not, I should not, I could not get the lower marks, and I score the best marks. So student, let us start with our the topic of risk management. So now identification of the type of a risk faced by the organization. Okay. First of all, when we talk about what are the various types of a risk, a business may face many type of risk. Important among are the discussed below. See, generally, when we talk about the risk, of course, in a maximum case, maximum time or maximum cases, risk is taken as a loss. Okay, and ultimately, risk lead to the financial losses. It lead to the whatever the risk, it will ultimately lead to the financial losses. But some risks are financial risk that we'll see what are they. So first of all, we start with the major one of the risk, strategic risk. Now, strategic risk means when a company when a company strategy becomes less effective and it struggles to achieve its goals. It could be due to technological changes, new competitors entering the market, shift in the consumer demands, and increase in the cost of raw material, large scale changes, etc. So see, these are definitions are illustrative only. These are not exhaustive. Okay, there can be other definition as well, but more broadly we can say that it is a broad change in the we can say supply, or it can be the manufacturing, or it can be so it is generally lead to our wrong decision, like the wrong acquisition decision. Sometime when we take a merger acquisition decision and a long, we acquire any wrong company. Okay, a company is doing the well, but just to diversify, they taken acquired a company, and they have incurred in the loss. So all these are taken there. Okay, now see, when we talk about strategic risk, so in real life, there are many examples. Okay, I'm just discussing with you one by one. Some examples are there that will make our discussion very interesting. But have you heard the name of Kodak? Okay, yeah, you may not be aware because when you have become the mature and you have seen the camera in your mobile and digital photography. But there was a time when Kodak was a company that was leading the photography business. Okay, because what used to happen, Kodak was developing was manufacturing the photo rolls. Okay, what do you used to do? If you ask your parents, then they will explain you better. There used to be camera. We used to click the photo. Okay, then we have to forward the roll, because on a one photo, is other photo is clicked, it will get spoiled. So then on the same, we have to complete this. Like so, in this case, by this doing, what used to happen? One reel may containing 28 to 29 photo. I remember that. Once the process is complete, we may seal the roll and take it to the photo studio. Okay, then there we used to give the photo studio, please develop this roll. Then they used to develop and give us the hard copy. Okay, now it is, if I say that in every mobile, every one person may containing thousands of photo, but those were the days there this was not possible. Okay, we have to keep these pictures in a negatives. There was used to be a negative from which you can develop again the pictures, but for the again watching them, we used to have an album, etc. So all this process was there, and Kodak was one leader. But what happened with the rise of digital photography? They ignored the signal. Okay, see, sometime in the risk management, there is very good thing. In the risk management, generally there are red flags are always appear, and we have to identify these red flags. So in this case, what happened? They ignored the revolution in the digital photography, like Nikon, Canon. They were all, of course, I think it was one said that although the digital photography had been invented by the Kodak, but they could not work upon that too much. On the other hand, Nikon and Canon and other companies took the lead. And due to this, what they have done, they have come out with a digital photography. On the other hand, with this Kodak camera, now they have come out with the digital camera where just we have to put up the chip. Okay, then we have to take the photograph, and this chip contain used to photograph that can be later on that can be viewed in the uh, our desktop or laptop, and even this can be transferred through the pen drive, etc. So this is was the development. Okay, with the rise of a digital photography, they could not conceive it. What is the thing? And they ultimately, once they marketed them in the 2012, they were filed for the bankruptcy. I remember that I was in the 2012. I was just reading the newspaper. In those days, internet or this social media was not that much popular. So when I was just reading the newspaper, and it really got surprised when I read this news. The bank Kodak had filed a bankruptcy. Then I completely read this article, and I found that because of this reason, they could not perceive it, the development, future, and ultimately they failed. So this is a one very example. Now, again, I giving you one example of your interest. You may have heard the name of Nokia. Okay, Nokia was one of the market leader. In say around 20 years back, there was only two companies. I think it was Nokia and a Motorola. Of course, Motorola is still existing, but I think you may not be aware about the name of Nokia mobile phones because they were using the concept of push button keypads. Okay, but with the coming of the this is your Android and Apple iPhone. Okay, so they sold to they ultimately could not came to know now the next time is a smartphone because smartphone was start coming and they were not aware of the same and they could not respond to the same. And even I think there is on Netflix there was a series on a BlackBerry mobile phone. Okay, of course, there was a one time around 2010, 11, the BlackBerry was very popular because their handset was used to very expensive and it used to work very well because just like mouse key, it used to work like on a keyboard, properly computer keyboard, and it has a unique feature. But with the coming of the smartphone, they could not adopt the technology, so they also failed. So this is one of the very blockbuster. It went bankrupt in 2010. Okay, somewhere they started their business in say 1985 in the USA. See, their business was basically on the videotapes or the CDs. They used to let it on the rent. Okay, earlier, see, now the student in today's time, Netflix, okay, and Prime Video, and Geo Cinema, etc. Now these are online OTT platforms are there. Now these are OTT platforms are there. Now you can watch any movie anytime. Okay, watch movie at any time. You can watch it as per your convenience. Okay, so this is a kind, and it is a kind of a curated offering by the companies that you can watch as per your own interest. Now there was a time when these were facilities were not available, and we have to buy the CD or we have to take the CD or the even video cassettes on the rent. So this company, what their business was, they were used to they were let out, or we can say they used to send this sold this DVD or videos on the rent basis. Okay, so they used to even they used post office. Okay, they use the post office and courier services from one place. They used to send it by the post to the other part of the country. Okay, and their business was doing very well. Okay, after a certain period this cassette or the DVD were also taken back from them. So this was a procedure and it was working very well, but they could not perceive the challenges of OTT platform. And with this coming of Netflix in the 2010, they have to file for the bankruptcy, and the company become bankrupt in 2009 because the now people have started moving on the OTT platform instead of hiring or buying. Because see, in a case of a OTT, even there was some period for which any video series or movie remains on the on the platform, then you can watch it again and again many times. Okay, whereas in a rental there was a problem for carrying the CD and you have to return it back after a certain time. So they could not perceive it. Okay, it is very important. Now, next is a very good example is Tata Nano. Tata has come out with a project of car named, I think it was used to be called Laktakia, something like that, because they were came out with a price of a car with the 1 lakh rupees. Okay, this cost was maximum to maximum was 1 lakh. Okay, but however, this car could not be take up because it is considered to be the cheapest car. And because and since uh, because as Tata is a very good company, so some luxury was expected from them. But since these have come out with some cheapest car, so they could not make out it. Okay, and ultimately the production goes out, discontinued. Okay, today if you have seen the any nano car, then it is a very rarely visible in the on the roads. But of course, earlier they have started producing it, but now they have discontinued. So these are the examples of our some strategic decisions that have gone the wrong. Okay, now I am coming to the next risk, compliance risk. Okay, now it arises when a company fails to comply with the rules and regulations related to particular area, industry, and sector. Now, what are compliances? Sir, I think one query has been asked. One second. I think there was a query. So whether printed Saransh will be available by Institute for Purchase? Yes, it will be shortly available. Student, please remember, it is in the printing process. I think it will be available shortly. Don't worry. Okay, it will be shortly available. So now, student, this is when we talk about the compliance risk. See, every industry or every sector has some need compliances to be met. Now, for example, if I say once you become the chartered accountant and you become the chartered accountant after say after coming time and you start practicing. Okay, so then you have to meet some compliances like you have to pay your fees. Okay, you have to complete your CP hours. So all these are compliances. Okay, that you have to meet. Accordingly, every sector had some compliances. Like for example, mutual fund scheme have some compliances. Okay, then insurance sector has some compliances. So all these sectors and every industry has some compliances. Like I just give you a very simple example. Like in the case of a company that is dealing with the foreign exchange, they have to meet the compliances of RBI. Because in an earlier organization, I remember that where I was working, there was uh, RBI requirements was there. So every I think quarterly I used to file the return, but later on it was discontinued. But I used to file the FCRA return, foreign contribution. So all these are kind of a compliances. Okay, so when you don't comply with these compliances, then of course the risk is there that it may result in your losses. It may invite the penalties. And even very good example of compliance is filing of the income tax return. Why we file the income tax return? Because it is a compliances. Why we file the GST return? It is a compliances. When we does not file our return on time, or whether we when we are late, and when we are not fail to deduct the taxes. So there are what are there? They are invite the penalties. Okay, they invite the penalty, then it is a loss. And even sometime it has been observed that these compliances can also result in a bad reputation as well. This company is not complying with standards. It is very common is because sometimes these compliances are very important. So these are one of the very important that they should also. Now let us see some examples of the compliance risk. One or two examples, then we will go for it before going for a break. Now there were very good example. Volkswagen. Okay, there was emissions scandal was very popular. Okay, because what I think somewhere around 2012, because they what they have done, they have used illegal software to control, we can say for to cheat the US emission test. Okay, they could not meet the standard and they given the wrong. wrong information. According to this, they have to lot of huge fine have been put on them, and even they have to recall their product. And when they recall their product, of course, it hampers the company's reputation. Okay, then there is a case of now it is a Meta. There was a scam of Cambridge Analytica case when they have sold the personal data or personal misuse of data to the third party app developer. Okay, so ultimately they have faced a huge fine of $5 billion, and ultimately global. So all these are we have to meet some compliances, but they fail to meet it. Okay, and even like Standard Chartered Bank illegally sanctioned transactions for countries like Iran, because there are some sanctions are there, but they have approved the transactions because they could not meet the anti-money launderings and other rules. Okay, they could not meet out the in the USA, so ultimately they were fined 1.5, $1.1 billion. So all this generally brings a bad name for the company. Okay, so we have to meet this another very important. I think there are many cases are there. Okay, that will be the suffice to for the understanding. Now, student, with this we are going for a short break. Okay, we will assemble after break of say 10 to 12 minutes. Ashok ji. this compliance risk. We have completed the same. And now we are coming to the next risk, operational risk. Okay, so this risk, operational risk is a very common risk, and there are many examples. When we talk about this risk, if we read this risk, and this risk is mainly we can see in our day-to-day life. We can say that it is a related to internal risk. In other words, it means the failure of the company to cope up with the day-to-day operational problems. Operational risk related to people as well as processes. Now, see, student, sometimes operational risk, of course, considered as an internal risk, but sometimes why it is considered as an internal risk? Of course, the impact is from the outside, but it is considered as an internal risk because it is due to some system failure or people failure on our part that organization suffers a loss. And in this regard, I can there are one of the very leading case operation risk. Whenever it comes at a case of operation risk, one second, student. Sorry. Yes. Now, when we talk about the operation risk, there is one very important case, Barings Bank's case. In this case, it is one of the considered as a very leading example for the Barring banks, and somewhere it around happened in 1995, where the Barring Bank, where it used to be called the Queen's Bank it was a London based and it was a basically British bank. So this bank has been collapsed due to one person, Nick Leeson. Okay, and he is also a movie named as Rock Trader. Okay, I think this movie may be available on any platform. Basically, in this series, in this bank, what happened? This Nick Leeson was in charge of the basically there are three tasks in the treasury system. One is it is called front desk, mid desk, and the back office, or we can say front office, mid office, and back office. So basically, this Nick Leeson was overall in charge of all these three offices. So whatever with the wrong he was committing on account of a say front office, what he is position was taking. So basically, he used to from the mid help of mid office and the back office, he used to hide all the losses, and as a result, the bank collapsed. Okay, so this is considered as one of the leading case of rock trader. It is considered one leading example for the operational risk. And there is another very recently risk has taken place, and that is AIM cyber attack, ransomware attack. In this, due to say lack of proper security system, cyber security system at the AIMS, their data has been hacked. Okay, so of course it has been recovered, but with a lot of efforts has to be done. So because of this lack of proper security controls, the data have been hacked. So this is a kind of a operation risk example. Okay, then there is another case, very leading case, Bhopal gas tragedy. And I think you must have watched the movie of there is a railway man series, I think on a Netflix, where all the this if you see this movie, so in this movie there was a lack on the part of the company to we can say to for the regarding the safety parts, safety measures. The company did not pay any attention to the safety measures, and as a result, this gas got leaked and and the rest is a history. So these are the example of the operational risk. Then there is another example of fat finger trading. It is also called it. What happened? Generally, what it is a fat finger trading in generally when we are trading on a terminal. So any wrong finger or any wrong punching of data can lead to huge losses. And this has happened, I think, with the Carvey in somewhere around in 2011, 19. I think with the Carvey, what happened? They have some fat finger trade, and the company has made a huge loss. Okay, so around 200 million rupees. So it is these cases are like that. And similarly, there was a one case of recently you have seen the blue screen. It is a very recent example. Blue screen outrage here recently the if you recall that I think somewhere in the 2024 our when we have opened the system there was blue screen was visible. Okay, so for the micro, so this was a, it can say due to some server error. So this was a kind of a operation risk. And even I think for the impact was such that even for some flights had to be cancelled in the UK. Okay, then there is another case of the British Petroleum in Gulf of Mexico, where the tragedy has taken place and there are leakage of oil. Okay, Gulf in a, Gulf Mexico Gulf. So all these are cases of the operational risk. So we can see that there are many cases where these are very common. Okay, so we have to see we have to strengthen our processes and we have to people need to be trained as well. Then I'm coming to the counterparty risk. Next is the counterparty risk. Sorry, I'm coming to first of all, I'm taking the now financial risk. Now this is the main area of our concern because since we are handling the paper of taking the paper of this advanced financial management, now it is says unexpected change in the financial conditions such as prices, okay, exchange rate, credit rating, interest rate, etc. Generally, see there are two topics. Basically, we can say for this exchange rate, there are two topics. Chapter number 9 and 10, and for this interest rate this is chapter number 11. Sorry, it is chapter number sorry it is chapter number sorry it is chapter number 10, it is 11, it is 12. Okay, so this is the foreign exchange risk management exposure and this is 11 number chapter international financial management. This is the interest rate risk management. So these are the three chapters that deal with this aspect. Now when we basically financial, of course every risk has a direct impact, but financial risk has a direct have a direct impact. Okay, so let us see what are the various financial risks that are normally encountered. Now we come to the broad categories of the financial risk. Okay, so what are the various categories of the financial risk? Let us start with the first, credit risk. Okay, it occurs due to non-honoring of the obligations by the counterparty. Okay, for instance, failure to deliver the goods for the payment of already made, vice versa, and for the okay, or the repayment of the borrowing or interest, etc. Generally, what happens? See, uh, what happens? Sometimes we have goods sold the goods on credit. Okay, but we are not receiving the payment. Okay, or it may be possible that we have made the payment in advance, but goods are not delivered, services are not delivered to us. Similarly, when we have paid the some loan or maybe we have lent some money to someone and they are not giving. So these are the kind of a counterparty risk, and in this, the other party is not meeting his obligation. And even this kind of a there are some examples of the counterparty risk, like in case of Lehman Brothers case. In 2008, Lehman Brothers crisis was there. It is also called the 2008 crisis as well, when the Brothers Bank, very old bank in USA, got failed. Okay, and due to this reason, what happened? Some payments were pending. Okay, some payments and need to be made. So all these payment are, you can say, could not be made out. Okay, this payment are could not be made out, and ultimately the counterparty suffered a lot. Okay, similarly, there was a one case of AIG bailout. AIG bailout, this case was there. AIG bank case was there. It was same arranged in 2008, where they have sold credit default swaps. Now, what is credit default swap? That when we discuss the topic of derivatives, here the credit, and it is one of the form of credit derivative. I'm not going into nitty-gritties right now. So, but they have sold some credit default swaps without any proper reserves, and ultimately when they have to meet the loss, their bank got bankrupt. Okay. Similarly, there is one very important example is given: Greek sovereign debt crisis. It is one of the very prime example. It is one of the very leading example. Somewhere around in 2010 or 12, the Greek, see what happens. Every country issues some bonds. Every country issues some bond to meet some their expenditure. Now, in this case, what happened? The Greek government could not repay the amount they have borrowed. Okay, they have started defaulting on the same, and that is called sovereign crisis called. Okay, my voice is less clear when I'm writing. Okay, I will take care. Okay, I don't worry, I will take care right now. Now, this crisis has taken place when the Greece government does not stop defaulting on the repayment of their bonds. So this is one of the considered as the best example of the operation counterparty risk. When the other party is not making the payment, the countries or the investor who have invested in the government bonds of the Greece government could not get their payment. Of course, there are some bailout package were offered, but of course, sometimes it creates a delay, and it also creates an interest loss as well. Okay, now next we are discussing one of the parties political risk. Okay, of course, this political risk appears to be somewhere around, say, other type of a risk, external risk. But what happens sometimes this political risk, what happens? The company affect directly, and in this, there are many cases where the decision or the, we can say, internal disturbances in any country have resulted into the loss to the company. Now, there was a very good case, that is the Venezuela nationalization of oil assets. Okay, during this period, what happened? The Venezuelan government has nationalized the oil business. Okay, so there were some companies like Exxon Mobil, etc. Company was there. They have established their plant there. So what they have done, it is also called expropriation risk. It is also called expropriation risk. In this case, government acquires the business but does not make a payment, or even make payment but very less payment. So it is a called just kind of nationalization of some business without adequate payment. So in this case, that they have nationalized the oil business and without making any payment, and this has resulted into huge loss to the oil companies. So this is a kind of a political risk is there. Similarly, Brexit crisis. The UK government decision to exit the European Union. So what it has created, it has created a very uncertain environment of uncertainty among the banks, and ultimately this has resulted to the loss to many banks. Okay, and they have to revise all the arrangements, FTA arrangement, foreign trade agreement, etc. have to revise, and it has create a huge loss to the companies. Many companies have been suffered a huge loss, and even due to this, the pound has also been affected a huge. Okay, and there is one very important case is considered Vodafone case. Okay, it is also called retrospective taxation case. And this case has happened in India, where in the 2017, okay, in 2012, the government has put the tax on the Vodafone for some acquisition deal in 2007. So this taxation, due to this taxation, they have suffered a very huge loss because they were not aware, and after 5 years, they are retrospectively they are changing doing something. So it was a case of Vodafone. So it is a kind of a political risk. Okay, now next we are coming to very important risk, and that is called interest rate risk. Now, occurs due to change in the interest rate resulting in the change in asset and liabilities. More important, banking companies as their balance sheet. Just a second. Due to changes in the interest rate results in the changes in the asset and liabilities. And more important, banking companies as their balance sheet items are more interest sensitive, and their base earnings spread between borrowing and lending rates. Okay, so it is one of the very important. See, in the interest rate risk, what happens when the interest rate changes? It creates a loss, and how it creates a loss, I just show you. Of course, there is a separate topic for interest rate risk. Now, how the asset and liabilities position change, and especially in case of a bank, it matters a lot. How it matters a lot, and just give a sum of rupees, say 1 crore, at the rate of say 6%. Okay, to Mr. Y, say 1 crore at the rate of say 9% or 8%. Okay, so here the bank also agreement is in the market, and it becomes from 6% to 7%. Now Mr. A appears to the bank and asks for his money back. Bank says we will levy the penalty. They say no problem. You levy the penalty and give back my money. Because even if you levy the penalty of say 0.5%, I am no bothering, because I am getting 7% rate of interest. This is more than say 1%, 100 basis. Whenever we use the interest rate terms, student, please remember, I am discussing with you one term. There is one term, whenever we use the term interest, 1 basis point. Okay, it is always means 0.1. Okay, 1 basis point means, so 100 basis point means it is also called BPS 1%. Okay, it is 0.1%. 100 basis point means, okay. Okay, so it is means 1%. So it means they're saying, yeah, I am also getting a benefit of, even I am getting a benefit of 50 basis point here. So they will say, my refund my money. Now, problem with this bank is that Mr. X is asking for his money, but Mr. Y will not refund the money, because now the same loan he will get at the 10%. He will say, I am not going to refund the money. Why should I refund the money? My loan is for the 5 years. You wait for another, say after 1 year, the ex Mr. has gone to, they will say, okay, you wait for another 4 years. So this is a kind of a risk there. Okay, then there is another variety of interest rate risk. And this rate is generally with the floating interest rate. This floating rate, it means interest keep on changing. Okay, when interest rate will keep on changing, then there is no problem. Generally, it goes by, say loan is with the floating rate of, there are two kind of interest, fixed rate and floating rate. Now, generally, the interest rate risk rises in case of a fixed rate instruments. There, I discuss with you another example. Say, today the rate of interest is 8%. Okay, you buy a bond at 100 rupees. Okay, so you will get a rate of coupon of 8% per annum in the years to come. Suppose after say 1 year, this rate of interest becomes 10%. Okay. Now, when this becomes same kind of a bond, it becomes 10%. If you go to the market and start selling the bonds at rupees 800, nobody will take with this you from 100. Okay. When you start selling if you're thinking that I want to sell my bond that is carrying 8%, nobody will buy the bond at 100 rupees. At what price it will be bought? At what price it will be bought? Just give me the answer. Just plain answer is there. If now I am not, I will say if you are Mr. X, okay, or I am Mr. X, I am Ashish, and I am purchased 1 year back this bond at 8% because the same kind of a bond was carrying 8%. I have purchased for the 800. Now today's same kind of a bond is offering 10% of rate of interest. Okay, now if I start selling, yes, not Geet, no, better no. I just show you. I just show you how much I will not show that. Now see, this calculation is made like this. To get, now this bond is carrying a 10%. Today is carrying, if I today I pay 100 rupee, I will get the coupon of 10%. To get rupees coupon, I pay rupees 100 as on date today. Okay. To get rupee 1 coupon, I pay. Okay. On the old bond, I will get the rate of 8% and that too on the 800. So I am getting rupees 8. I will pay. So I will say I will pay only 80 rupees. Okay. I will pay only 80 rupees. Okay. Because on the 80, if I say calculate 8%, sorry. Okay. So is it clear to you now? So I will not pay this much of amount. I will say I will pay lesser amount to you. One second. Rupees 1. I'm getting this. Okay, student. So by this, if you are holding a bond of 100, you will have a loss. You will have a loss. Okay, student. So this is the interest rate risk. This is the due to interest rate risk. Next is currency risk. It is one of the very important risks. Mainly affect the organization dealing with the foreign exchange as their cash flow changes with the movement in currency exchange rate. This risk can affect both adversely as one second. Very important line. I'm just writing it again. Mainly the organization dealing with the foreign exchange as their exchange rate changing with the movement in the currency. This risk can affect both adversely and favorably. It is the beauty of this risk. Okay, it is the beauty of this risk. Now you will say, how, sir, it is the beauty of this and how it is good? Because see, I just give you an example. See, this all the discussion is very will be in the detail. Now suppose, just roughly I'm saying, today say $1, and mainly this risk is faced by the organization that are dealing with the foreign exchange. If any company is dealing domestically, see, when we talk about the foreign exchange, first of all, try to understand what is foreign exchange. See, foreign exchange means when we cross the, for doing the business, we cross the boundaries. Okay, once we cross the boundaries, then we face the, we expose ourselves because our currency is not acceptable to the other country's buyer or seller. In today's import and export business, so the other country may not accept the other country may not accept my business. They may not accept the my currency. Okay, so we have to go by some currency that is common to all. Like generally, dollar is a common acceptable currency. So that's why I'm taking the dollar example. Okay, so today's, if my $1 is, say, price is rupees 85. Okay, now I suppose if I am an importer. And student, see, one very important thing is to note that generally in foreign exchange transactions, there is always a time gap. There is always a time gap between transaction and the payment. Between transaction and payment, there is always a time gap. So you have to very careful, because when due to, because generally what happens in a, like in case of a India, when we do this domestically business, suppose if I go to the shop, okay, and select any fridge, okay, I make the payment, the dealer get it loaded in the truck or a rickshaw, whatever it is, and get it delivered. By the time I reach my home, it generally get along delivered to my doorstep. But in case of a foreign transaction, generally the routes are very long. It generally involves a sea trade, sea routes. So in this case, that generally there is a time gap between the foreign between the transaction and the payment. So and due to this, generally there is a fluctuation, and due to this fluctuation, there is always a problem of foreign exchange risk. So let us see how it takes place. Okay, now suppose if I am importing goods worth of rupees 1 lakh. Today, say I am 23rd July. Okay, today I am importing this much of goods. Okay, agreement has been entered. The goods have been started from there. The goods will be somewhere reach around say 1 month or something like that. Okay, I have to make this payment say after 3 months. Okay, today I estimate that at this rate, my cost of this consignment will be 85 lakh. I say my cost of assignment will be 85 lakh. Now say after 3 months, when the actual payment time comes, the dollar becomes say rupees 87. Okay, now what will happen? I have to make the payment of, because I have to purchase the dollar. To make the payment, I don't own the dollar. I don't have the dollar. I have to purchase it from the market. Okay, bank. That we'll discuss in chapter number 10. Okay, when we're there. Okay, so I have to make the payment of 87 lakh now. So this 2 lakh loss will be my foreign exchange adversely. It will affect me adversely. Now I am coming on the other side when it will affect me favorably. How? Now suppose if I am exporting goods. Now I am exporting the goods. Now when I am exporting the goods, the same scenario is there. Today is 23rd July. Okay, I expect that my revenue from the assignment At today's rate, I estimated that 1 lakh into 85. So I am expecting ki 85 lakh rupee I will receive. But what happens after 3 months, say 22, 2010, the dollar rate increase. So my revenue will be now when actual money will come to in my hand. See, 1 lakh dollar will be come to me and I will sell this dollar in the market and I am getting 87 lakh. Of course, I am getting rupees 2 lakh more. So in this case, this exchange rate has affected me favorably. And even this also happens in case of interest rate risk. We can say this also happen in interest case risk, because if the interest rates are like in this case, if I am holding a bond that has been issued, say I'm also now I am taking to the interest rate risk. Now suppose I take my how they see the beauty of this uh, financial risk, that sometimes it also affect favorably. Now I also show you how my interest rate also favors for me also. Suppose I have taken the example of 8% bonds at rupees 100. Okay. Now suppose after 1 year, rate of interest goes down to 6%. Okay. Now whether I will sell this bond at rupees 100 or not, please tell me. I need yes or no answer only. Will I be ready to sell this bond at rupees 100? No. Very good. Chandra, very good, beta. No. Why? Because as I told you, same. Now, if any person comes to me and he asks, "Sir, I want to purchase this bond, so I will pay me, sell me at 100." I will say no. I will not sell to you at 100. Then he will say, "How much price you will charge from me?" I will say, "I will charge price from you 8 divided by same logic into 100, and the resultant figure comes." So here I am gaining. Okay, my gain is 33.33, and here I was losing of 20 rupees. So this is the beauty of this interest rate and foreign exchange risk. It also worked adversely and it also works in a favor. Okay, student. Now we are coming to the next risk. Liquidity risk. Now, broadly, this can be defined as the inability of an organization to meet its obligations whenever they become due. Mainly arises when they are unable to generate adequate cash or they are mismatched. In a cash flow generation, more common in a banking business. In a banking, it is very common. And when I talk about this mismatch, you may recall that there is one topic you have studied at your intermediate level. Then you will recall. Just apply your mind. There is one topic. It is related to you. Just you have studied it in a working capital management. I am giving you the hint. Where you have to estimate that our over trading, some not over trading, but it is, if you recall that it is kind cash budget. Why we prepare the cash budget? Have you seen the what is the purpose? See, when we are preparing the cash budget, what is the purpose of cash budget? We have, because we have to prepare budgets. That is our sales budget, then our receivable budget, then your material budget. All the budgets are prepared. Then we have to see how the what will be our shortfall and what will be our surplus. Because for the shortfall, you have to arrange the funds well in advance. The purpose of the cash budget is that. And generally, this mismatch generally more happen in case of banks because they estimate that our maturities are likely to be this, but sometimes it may be problem. Generally, it happens in case of a bank rush. Bank rush means, see what happens. Bank normally borrows the money and keep a very minimal amount as their reserve. Okay, they keep a very minimal amount as their reserve. What they do, they just say 10 to 15% or whatever. This is called cash reserve ratio. What is called cash reserve ratio? A bank has to maintain a certain ratio of the borrowed amount in the form of cash to meet the withdrawal of cash, etc. So this ratio is generally lesser than your original one because they normally lend the money in the market. Now, if any bad news comes for the bank, every one person runs to the bank to get back out their money. And here this is called bank rush. When a bank rush is there, the bank it becomes difficult for bank to meet the cash require to meet the we can say they could not meet the demand of the customer to that of their withdrawing the cash. So this kind of situation normally happens in a bank. Of course, it rarely happens, but normal course sometimes what happens, and in this case, what happens? There is very see everything is interlinked. Suppose a bank is having a some deposit. Okay, yeah, this is called. I just tell you one thing very very interesting thing. Suppose a bank may have in their reserve say 15 crore, say or say somewhere. I'm just taking a very simple example. Say 150 crore in their reserves. Somewhere cash is there. Okay, but tomorrow suppose there is one withdrawal has come so fast due to some reason, any reason can be there. The withdrawal say somewhere around 175 crore rupees. Okay, and they know that tomorrow I have to give make the some withdrawal of say 100. Now question comes from or they can say payment transfer, not cash withdrawal. They have to make some payments. It can be form of any transfer. They know that in 150 in our account and we have to make the payment of 157. Now here generally the repurchase agreement that is called repo that we will discuss in the topic of security valuation comes into the picture, that is called repurchase agreement. What one bank does, they sell the securities to the other bank with a commitment that I will repurchase these securities back along with the interest from you. Okay, so this is called repurchase agreement. So all these things are related. I want to just let you know all things are generally interrelated. So this is generally called the liquidity risk, and there are many examples of the liquidity risk like in interest rate risk. There are one very good example, Silicon Valley Bank crisis. Okay, around 2023, the Silicon Valley Bank. I'm just writing here the name. It is a very good example. I forgot to include it. Okay, in this case, what happened? They brought the long-term bonds. Okay, their value lost when the interest rose. Okay, I have shown you because they have purchased some long-term bonds, but their value gone down when the interest rate rises. So ultimately, this bank collapsed. Okay, so all these are examples. Now, similarly, uh, foreign exchange risk is very common. Like it generally impacts the our if you understand generally in our in a country like India, the petrol prices are driven by the foreign exchange risk. As the dollar becomes stronger, we have to pay more amount to the so for the petrol or the diesel, etc., because our 80% of consumption is imported import from the outside. Okay, then liquidity risk. There was one case of Northern Rock. It is one of the very famous case because this bank relied on short-term borrowing for long-term purpose, and ultimately this amount has ultimately they could not meet out the they could not meet out the requirement of the customers. So all these are examples of this uh, our risk like interest rate risk and of liquidity risk. So these are the major financial risk. Okay, now we are coming to the next topic, next part, that is how we evaluate the financial risk. Okay, now when we talk about this financial risk, just read it. Since major risk holders of a business are equity shareholders, they view the financial gearing, that is ratio of debt to the capital structure of a company, as a risk. Since in this event winding up, the company, their priority will be the least. Now, student, if you recall that in your paper of financial management, there was a one topic, if you recall that, that is linked to this risk. It was linking to this. There are two kind. It was linking to two risks that you have discussed. Just recall it. I think it was in chapter of capital structure, or you may cost of. I generally it is studied in the capital structure. There was two risks have been discussed there, and you at that time you have got some hint of financial risk. Just give me the hint of this topic, or just name it. Just this two words topic is there. Three basically there are three categories. I'm just giving you the hint. There is a one broad category. Under this, there are two subcategories. Or you just give me one word hint. Yes, gearing is here, but we use other term as well for it. Gearing, I got it. There is one term also used for the same. Yes, Chitra, you are correct, beta. It is called leverage, financial leverage and operating leverage. So here the generally the shareholders consider it from the financial leverage point of view. Higher the financial leverage, higher the financial risk. Of course, gain is there also. Risk, the beauty of risk. Higher the risk, higher the gain. Okay, higher the expected gain, not gain, expected gain. But loss is also very higher. So this is called, we can say that is a financial leverage. Of course, there was one your operating leverage, mainly that is related to your operation of the business. But in case of a from shareholders' point of view, this financial leverage is very important because they consider it as a risk to them, because if the company liquidates, they are at the last. Ultimately, priority is given to the debt. So from company's point of view, the company borrows excessively land to someone who default. That is more important. If any company default to lend someone and that person default, then company can go on into the problem. So that's why it is always said that bifurcate your money to different lenders. Okay. Okay. So because if the otherwise there will be concentration risk. Then this is called concentration risk, because if you concentrate on any one person, or even this also happens in case of where your supply or your sale, you are selling goods to one customer, or you are 100% relied on it. Tomorrow this customer says no, your business will collapse. So you have to expand your business. You have to get multiple. So that's why you have to look for other customer, even for the supplier as well. Then from government point of view, if financial risk can be financial failure like Lehman Brothers, or downgrading of any financial institution, leading to spread of distrust among the society, and large and even this risk include willful defaulter, can also lead to sovereign debt crisis. Sometimes even it has been seen that some defaulter, some person has willfully has defaulted as well. Okay, and even sometime this crisis has also resulted because some due to some, we can say that some some even willfully default, make the default. It has been observed in, there are some cases in India as well, And even sometime what happen, even it could lead to the sovereign debt crisis as well. Now, student, when we talk about the risk, now we are coming to the slowly we are coming to the practical part. So there are concept of value at risk. This topic I will take in the next class because it will involve a lot of discussion. But before what I do, I just take up the topic of measure of if I say risk. So first of all, when before I discuss the topic of value at risk, in the next class I will take up this topic. I just now how to measure the risk. I just ask one question: how to measure the risk? This is a question. Of course, we have talked about a lot of risk, but now question comes how to measure the risk. Now I need a very answer from your at your end. Just share with me whatever coming to your mind. No problem. No, see, student, never whatever coming to your mind, you can share with me openly. No problem, because it hardly matters. If you are wrong, no problem. It will get corrected. Whatever it is coming to, and how we measure the risk broadly. Of course, there are many methods, but one measure is very common, and that you have studied at your yes, Pitambar, yes, you are right, because you have referred this method at your, I think, in the 11th class in the your statistics paper. At very basic level, the risk is basically how we measure the broadly. It is called the standard deviation. Okay, what is deviation? Now, in the when I was speaking some in the beginning, in the somewhere in between my lecture, I have used this word deviation. Risk means when you deviate from some standard or some expected value. When you deviate from some standard or expected value. Okay, so when I say standard deviation, it is a deviation from some standard. Okay, I'm just giving a very small example. Okay, let us do a small example. Then we will understand how the this standard deviation works. Suppose stock of X Limited has this return in say last 5 months. Okay, say month is January, Feb, March, April, and May. Okay, return is like this: 4, 6, 8, 2, 10. Okay, now what is the expected return? Now, what is the expected return from this for the 5 months? Give me the answer. Yes, Pitambar, you are right. The return is 6 because I add up the same. Okay, average or expected, because average is kind of a thing. So average means divided by 6, so it is 6%. Okay, now I have to calculate it deviation. Okay, how we calculate the deviation? We have to calculate it like this. Of course, you will carry out a lot of calculation when we will do the topic of portfolio. 4 minus 6. Okay, this is deviation. Okay, so now deviation is before me. I'm seeing it is deviating in many cases. My expected return was somewhere around 6, but it is deviating in many cases. So what I have to do, I have to square it out. Why I have to square it out? because I have to nullify the impact of negative sign. In these two figures. Okay, so accordingly, I start squaring of it. Okay, so total comes 40. Okay, total comes 40. Okay, when this has come 40, I again divide by number of observation. It becomes 8. So it is called beta variance. Okay, this is called variance. Now when I have to compute standard deviation, I take square root of it and it becomes 28.3%. Okay, so now what does it indicate? It indicates that my expected return is 6%, but there is a return. Typically, return can deviate plus minus 2.83%. Okay, okay, you got it. So I can say that typically there is a chances that my return is likely to be very this much, and accordingly we can always remember higher the standard deviation, higher the risk. So it is one of the very basic measure. Okay, and we normally use it. So I'm just another case I am taking, like when we talk about the portfolio management, say there are two securities. One is say security X, another security is Y. So this is their return for the 5 months. Okay, now if I calculate its mean, the mean value is say 5.4% here. Here it is coming 8%. So I am getting more return here. It is a good security. But once I calculate its standard deviation, I came to know its standard deviation is 0.49% and its deviation is somewhere around 6.14%. So I can see, of course, my expected return is on a higher side, but I also carrying a good risk as well. Okay, student. So this was for one of the measure. We can say measure of the standard deviation for the measure of risk. So, student, I think regarding this topic of value at risk, we can cover it start in the next class, and there are assignment has also been there on the chapter number 2. So we shall complete this chapter in the next class. Okay. So meanwhile, if you have any query, Ashokji, just open the session for the student. Student, you are free to ask the query relating to this lecture and previous lecture as well. I think there Mishra was. I think Pitambar Mishra, you were asking some about cash flow, na? Okay, just switch on your mic, please. You are free to ask.
Yes, sir. I was asking in last day's question when we
When we pay the dividend, you are asking that, na? But do you know the concept of cash flow statement?
Yes, sir.
So you do one thing. You prepare a cash flow statement of the same scenario one.
Okay, sir.
Okay, do start with your opening balance. Okay, add profit. Okay, deduct. See, debenture repaid. Not sorry, long-term loan repaid. Okay, you deducted dividend repaid. There is nothing in first scenario. And see, deduct increase in the current assets other than cash. Please note it.
Okay.
And add increase in current liabilities. That is accounts payable and outstanding expenses. Then you will get the answer.
Okay, sir. Got it.
Okay, even if it is paid, you just try it. If it does not match, you come in the next class.
Okay, sir.
Okay, student, please note in the schedule there may be in the next class is written like capital budgeting, but today I will get it corrected by evening. So please, this class of the risk management will be continued in the next class. Okay, if you have any query, you are free to ask me at this number. Today I may slightly busy, no problem, but still you can contact me, and you can even mail me at sfm-final. Okay, student. Okay, student. Thank you very much for today's session and making it interactive and listening patiently. So, students, see you in the next class. We will complete this topic. Thank you very much. यस ओवर ही कर दीजिए आप देख लीजिए कोई और मैसेज आ रहा है तो देख लेता हूँ लास्ट टाइम 1 मिनट और वेट कर लेते हैं देख लेते हैं फिर इसको कर बंद कर ओके अशोक जी ठीक है बाइंड अप द सेशन प्लीज